What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is May 3rd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about the major macro events that are coming later on here today, and how it's not only going to be affecting Bitcoin's price, but the broader asset markets. Today, we're going to be talking about no other than the upcoming FOMC meeting that's going to be hosted later on at 2 p.m. in the afternoon Eastern Standard Time. This is where the Federal Reserve is going to be dictating where monetary policy goes in the future. And not only are we focusing on the federal funds rate, which is what everyone is talking about, but we're more particularly going to be focusing in on the topic that no one seems to be discussing, and that is the Federal Reserve central bank balance sheet, which so many people were talking about just a couple weeks ago, but have seemed to ignore when the trend is starting to reverse. And this is an imperative thing to know about. But before we kick off today's video, I want to take a moment to talk about something that's becoming growingly relevant for all of us, especially those of us in the crypto space, and that is no other than identity theft. Today we're going to be talking about our sponsor, Aura. Aura is a 360-degree identity theft protection platform that provides a full suite of services to protect you when you browse online. Rather than needing a multitude of online subscriptions to keep your personal data and web activity safe, Aura offers up to $1 million of identity theft insurance, a web VPN, password manager, personal privacy assistant, and an email alias tool to prevent unwanted emails and data breaches. They offer all of this for the low cost of just $12 a month. Each year, over 15 million Americans experience identity theft, with an average loss of $3,500 each, and 1 in 5 people in the EU have experienced identity theft in their lifetime. The cost-benefit analysis is clear. One of the greatest investments you can make in yourself is protecting your online presence, and Aura can help you get there. In order to do this, check out the link down below in the description, where you can start on a free 14-day trial utilizing my link down below in the description in order to see if Aura is the right fit for you. Alrighty, everyone, so let's go ahead and kick things off by taking a look at Bitcoin's price. The first thing I want to point you guys to is the fact that we've been continuing to push sideways here for the past month and a half. The trend is starting to signal some red flips on the daily time frame, signaling uncertainty and inconsistency in the trend, and could likely be the first sign here that we are starting to prepare for a move to the downside, again playing into our short thesis. Now, we don't really have any serious momentum just yet to the downside or anything that could initiate that trigger on a short sell. We still have on the weekly time frame the bulls in charge here, to be completely fair. That momentum is fading, and it's fading fast. And this leads us towards talking about what really drove this rally. Well, we believe this is a clear relief rally, not the beginning of a new bull market. And it has to do with the fact that the narrative is flawed at its core. The idea that Bitcoin is going to be this asset that everyone is running to, and in fact, not that it's just going to be, but it is the asset that everyone's going to right now. That billions, if not trillions of dollars are flowing into Bitcoin as an alternative hedge, as the banking system collapses due to the Fed's monetary tightening. That's the narrative that people like Balaji, previous CTO at Coinbase, who's become a huge figure in the Bitcoin ecosystem, has been preaching for the last month. In fact, he made a $1 million bet that we were going to see a $1 million Bitcoin price tag within a month. Now, I think most of us obviously didn't believe that that was going to be the case, and many might even say that Balaji didn't even think that that was going to happen himself. However, this does not justify making some outlandish price figure. And I really don't like this whole kind of spin that he claims he burned $1 million, even though he did stick to his promise. I'll give him that. At the end of the day, I don't really see this as too much of a sacrifice on his end. He's probably got millions upon millions of dollars of money in crypto. It's a blip on the map considering the expansion of his portfolio since making this call and getting a lot of people to FOMO in. And this is simply not the way to market an asset like crypto. You don't get to just make outlandish price figures and say, oh, I made this figure because I just wanted to encourage people to do research. No, you need to be able to come out with factual statements, try to be as rational as possible, and at the end of the day, good ideas will win in the end. People will slowly wake up to them. That's why Bitcoin expanded on its own over the last decade, simply setting in new all-time highs during a period of monetary expansion. And this takes us to the important point we need to understand. This narrative at its core is flawed because we are not seeing monetary expansion. Take a look at stablecoin liquidity. We've talked about this for months now, guys. This has been declining since back in May. Every single time we had a bull market over the last decade in crypto, we saw stablecoin liquidity expand. We saw Tether getting printed like wildfire, and as new stablecoins came out like USDC, DAI, and all types of other players, we saw bull markets kick off. Notice from January of 2020 or here in December 2018, both of these periods and the previous bull market saw massive expansion of liquidity. Where are we right now? We're not seeing anything. Liquidity is flatlined, and there's a good reason for this. The reason is because it's not just stablecoin liquidity that's flatlining, it's global liquidity. Balaji and his narrative has fallen apart when you understand what's going on with the US M2 money supply. Sure, central banks printed a lot of money over the last 2 decades during a period of QE and financial stimulus. But that is not what's going on right now. And this is the difference between people who are trading in the same mindset of the last decade or so versus those who are planning to trade for the next few years or invest. Doesn't matter. Take a look here at the US M2 money supply. This is a measurement of the broad money supply within the economy. And since back here in January of 2022, we've contracted from over $21.84 trillion of liquidity down towards 20.81. Now, that's a $1 trillion pullback in the amount of liquidity in the system. And I understand, for sure, if he's talking about the last decade, he's got a point. Yeah, central banks printed like wildfire. And that's why we're seeing the inflation we have now. And this is why we've got to talk about the upcoming FOMC meeting later on this afternoon. First off, we need to understand that the Federal Reserve is likely going to be raising its federal funds rate by 25 basis points, further increasing the cost of capital. However, this is something that the market has already relatively priced in, as prediction markets are predicting a 90% probability that the Fed is going to raise interest rates to 500 to 525 basis points. Standard 25 basis point rate hike. Now, this is something that, again, just back a couple weeks ago was not the popular opinion. Probably about 30-40% of people, including ourselves, thought that that was going to be the increase. That has now risen up to about 90%, again proving that equity markets have been thinking optimistically, hoping that the Fed is going to pivot sooner rather than later. But as we're going to talk about here, it's not just a matter of the federal funds rate likely sustaining for much longer at these rates, as we targeted way back in the day. Back over a year ago, during the last summer, we talked about how the Fed was going to be expanding interest rates towards around 5%. We are likely heading towards that target later on today, hitting that, improving that prediction right. But on top of that, they are going to have to keep that rate there for a very long period of time. The markets are pricing in that the Fed's not going to keep it there for as long as it's claiming. But I have to tell you guys, when the Fed is finally in the driver's seat, when there is inflation in the economy, that is when the Fed is going to take control. That is when they're willing to allow some things to break in the economy in order to tame inflation and bring back equilibrium between supply and demand. Another big thing we got to talk about here that no one is discussing from what I see, and it's ironic because it was the topic of discussion for bulls all of last month, and that has to do with the balance sheet expansion or the balance sheet contraction that is continuing. Now, I know a lot of people, when we had the banking collapses of SilverGate, we had Silicon Valley Bank go under, some of the biggest bank failures we've seen since 2008, of course, the Federal Reserve came in and bolstered its balance sheet. And a lot of people looked at this and they thought, oh, this is the new wave of QE. This is going to print another $2 trillion of liquidity. The Fed's going to come in as they usually do, drive the balance sheet up to new all-time highs, and equities as well as crypto are just going to skyrocket and go to new all-time highs. And some people are pointing as well towards some balance sheet expansion in Asian central banks, etc. And they're saying this is what's going to save the market. But at the end of the day, the U.S., the central bank of the United States, the Federal Reserve, are what drive bull markets. If the Fed is not expanding its liquidity, then we've got a problem. As the dollar is the world reserve currency, it sets the tone, especially in an inflationary environment. China and many other countries do matter, but the dollar matters most. And what do we see here when we see the balance sheet? Well, since back on March 20th, week by week by week by week by week, we are seeing reductions in the balance sheet of tens of billions of dollars, back on track to what we've seen prior over the past. So what's going on here? Well, we first need to understand that not all QE or balance sheet expansion is equal. The Federal Reserve, what it did is provide immediate short-term relief towards a variety of banks in the economy who were at risk for bank runs or liquidity crunches. This was in order to prevent a sort of contagion within the financial system of bank runs from bank to bank, and to get people incentivized to feel comfortable knowing that their bank is going to be solvent and secure and that they can trust that the deposits are there at the bank. The thing that the Fed did not do, though, is stop its quantitative tightening program. That balance sheet reduction probably looks really similar to what we've seen over the past few months because it's the exact same program. And those loans, bear in mind, that the Federal Reserve made to these banks are temporary. They will also play into this liquidity contraction as banks slowly settle out these loans and as the ideally banking contagion slowly starts to dwindle. This is going to take us right back into the same environment we were in back a couple months ago, back in February. Now, this is something that, again, if you guys are interested to learn about these things, if you want to see more details on this topic about what we predict the Fed is going to do, not just here today, but over the next couple of months and what it's going to mean for asset markets as a whole, you guys can check out our newsletter, the Dash Report. It's a newsletter we write here on the channel. And not only is it going to give you access to a 20-page plus newsletter, you're going to get access to our monthly trade setups, as well as exclusive market updates, our mid-month webinars, access to the Dash Report discussion group, and on top of that, you also get access to our key momentum indicator that we utilize within the Dash Report ecosystem in order to find opportunities not just in crypto, but across a whole range of markets like stocks, commodities, and Forex. It's a great way where you guys can support the channel. You could get 20% off by subscribing annually, and it's just a great way to get more information on top of the free content we give here on the channel. If you guys are eating up what I'm putting out there, then it might be the content for you. And it could be at least a good content piece for those of you who even may disagree to kind of open up your perspective and see where I come from when it comes to my reporting. That's all it is. I don't want to claim to always be right, but I think it's something that can really help you guys on your trading journey. Now we need to go ahead and talk about what the Fed is up against. I know a lot of people are saying, but Nick, okay, sure, maybe the Fed is going to tighten for a few more months. Yeah, maybe interest rates will last at these ranges at 5% for quite some time. Maybe you were right on that, but isn't inflation almost done with? Aren't we, complete and actually cooling inflation? Well, the Fed is definitely stepping in the right direction. Don't get me wrong here. I see what's going on with oil prices. Oil is back down towards its relative range in December. We're here in March, and it looks like it's going to continue to roll over here. Our momentum indicator is not signaling any chance for oil to really continue moving higher, at least at its current pace. We haven't seen a sustained blue flip here on the weekly time frame. Most of it has been in the red, and that shows trend inconsistency for the bulls, leading to the narrative that the bears will likely continue here, essentially dragging oil prices lower, especially after the cuts we saw from OPEC nations. Now, the other thing here, as well as a plus, is that the Strategic Petroleum Reserve, although it did see a little bit of declines here in April, generally is not being utilized by the federal government or the Biden administration to tame inflationary pressures in oil. That's also another big plus here. So again, kudos to where it is. At the end of the day, energy markets are starting to cool down. This has been a big volatile element of inflation. Same goes here for natural gas prices, down a whopping 75 to 78% from the all-time high peak here in late August of last year. And as we can see here from the TTF, or Dutch TTF natural gas calendar month futures, good way to measure kind of energy prices within Europe, we've seen a near 90% reduction in energy prices throughout Europe. This is a really good sign from that absolute peak. But Federal Reserve needs to not only drag energy prices lower, but they need to keep them there. And I promise you guys this, if the Federal Reserve starts to back off too soon, if demand starts to surge in the economy, if what you're seeing in the stock market doesn't convince you enough that financial conditions are eased, what happens if the Fed were to print money? What would happen if the Fed started to cut its interest rates too soon? These prices, these goods and services that rallied so extensively over the past year are going to come right back up. So we need for some time to see continued contraction here. And outside of that as well, the other big thing that many people aren't talking about is home prices. Home prices have been relatively flat most of 2021 and 2022. And now finally, we are starting to see that top formation we are finally starting to see a decline. Back in the end of the quarter, Q4, we saw housing prices drop by about 6.5% for average sale price. However, that needs to continue climbing much more to the downside, descending lower to the downside, so to speak. Just take a look here at our momentum indicator here, right? We're looking at the quarterly time frame. And take a look at 2008 as an example. While we are maybe going to repeat history and have such a correction here, that's actually not really my point, that we need to have some major correction. What we need to see is a plateau, or at least some kind of corrective effort within housing prices in order to get back to a point where housing prices are not expanding at such a rapid rate. Incomes can slowly catch up to those the cost of living for a new home, and that's what leads us back towards an inflationary environment of around 2%. So I'm not calling for some absolute disaster. If there's the people who have been going out and buying up Airbnbs with credit and speculating and trying to earn passive income, yet some of those people are going to get knocked out, especially those who bought at ridiculous real estate prices. However, all I'm saying here is that it's going to take a lot of time to get to that 2% figure. I guarantee you guys that here. And I understand a lot of people are worried about what's going on with the regional banks, but what I think is going to likely play out here is that not all regional banks are just going to go away or disappear. You're going to have some mergers, some acquisitions, but after a couple of these bank runs go through, it's just going to leave a position where these banks are at a cheaper rate than they were back a couple months ago, in line with the third lower low comparative to the lows we've had back in March of 2020 and the low range from 2013 and 2015. That's been our prediction since we had this first pullback, and it seems like it's the one that's playing out. It's not some doomsday scenario where the entire system is just going to evaporate overnight, where the US loses its seat on the world stage. It's about preparing to understand that sometimes we have corrective forces in the economy, not overshooting our estimations, that things are just going to collapse overnight, but also not seeing things as constantly euphoric. Things are always going to be going up, just like they were over the last decade. It's a new trading environment because the monetary policy has shifted. The narrative, the core fundamentals have shifted as well. And while the crowd may not feel that way right now, I think after today's FOMC meeting, the tone is going to be clear, similar back to August of 2022 last year, when the Fed put down the hammer and made it clear that getting inflation to 2% is its number one goal. That has not changed since then. And while markets may think different, that is the number one goal for the Federal Reserve. Now, what I saw yesterday in the VIX, although it did cool down, was definitely my warning sign here that the Fed is coming up with something big. Markets who have been enjoying this kind of ride up here see the FOMC meeting as a potential catalyst for a trend shift. There are very few big macro events like this, like earnings season and the Fed FOMC meeting, that are those points where things can really start to shift, where investors can, or previously who have been riding narratives, who've been riding the wave of narratives, start to realize that a lot of it is built on nothing more than sand, and that the quarterly financials are not going to hold up, the future outlook is not looking good, and that the Fed is going to likely have to tighten for much longer than previously thought. These kind of elements, when they start to come into play, they not only cause volatility, but they lead towards equity prices correcting. I've rambled on a good amount here, guys. I don't want to ramble on too much, but I want you guys to come in prepared to this. And this takes us back to what we've been talking about for the past couple months here. Whether it's Bitcoin, whether it's stocks, at the end of the day, we need to be prepared for a continued contractionary environment. Relief rallies, or liquidity traps, as we like to call them, can be incredibly deceiving. And I'm not here to show you guys my referral links towards leverage trading exchanges, telling you need to go speculate, go all in on Bitcoin. It's going to $1 million, so why don't you 10x leverage and take all your money? That's the kind of stuff that's going to leave you burnt. And the sad thing is, while I'm not saying we haven't gotten things wrong here in the channel, right? Sometimes people are going to make wrong calls. People who make those really far out bets do not have any repercussions for it. Only you at the end of the day as a trader, whether you like me or dislike me, at the end of the day, you've got to be able to make those decisions for yourself, guys. And I'm just here to try to give you as much of a rational opinion as I can on the current circumstances of what we're living through. It's a very unique time. We haven't been in this situation or a similar situation in nearly 50 years. It's going to be a bumpy ride, but if you can hold out through it and know when it's really time to strike, and trade against the counter trend, you're going to make a lot of money in the process. It's very, very likely. Anyways, guys, I've rambled on a good amount here. If you guys enjoyed this video, consider dropping a like, consider subscribing if you haven't already, and I'll see you guys in the next video. Take care, everyone.